Welcome back to the deep dive. It's truly incredible how much information we're bombarded with every single day, isn't it? Just trying to keep pace with the news, let alone genuinely grasping these really complex, rapidly evolving topics that are, well, reshaping our world. It can feel like a full-time job sometimes. But that's precisely why we're here. Our mission really is to be your shortcut to becoming truly well-informed. We want to extract the most important nuggets of knowledge and insight so you don't have to wade through that endless stream of data yourself. We aim to give you the comprehensive context you need without making it overwhelming. Okay, let's unpack this. Today, we're taking a deep plunge into a topic that's not just making waves, but truly redefining the very fabric of finance. Decentralized finance. You probably know it as DeFi. It's often heralded as nothing short of a financial revolution, boldly promising to fundamentally alter how we interact with money by, well, largely cutting out those traditional middlemen we've grown so accustomed to. Think about that for a moment, a world where your financial interactions aren't controlled by banks or brokers, but by code. It's a pretty mind-bending concept.
And that's precisely why this deep dive is so crucial. Our mission today is really to guide you, our listener, through this incredibly intricate world of DeFi. We want to give you a thorough and well-rounded understanding of its context. We'll explore its fascinating origins, delve into the core technologies that actually empower it, unpack the diverse financial instruments it has already spawned, identify the key players driving its evolution, and perhaps most critically, examine both its compelling, often quite idealistic promises and its very real, sometimes underappreciated perils. All the insights we're sharing today are meticulously drawn from comprehensive sources, everything from rigorous academic journals and policy papers to, in-depth industry analyses. This ensures you get a balanced expert perspective.
Okay, fantastic. So let's start right at the very beginning. The genesis of decentralized finance. The big question is, why now? What was the spark? What was that foundational moment that ignited this entire movement? To truly grasp that, I think we need to cast our minds back to a really pivotal moment in recent history, the global financial crisis of 2007-2008. That period of immense instability, coupled with, frankly, a profound loss of trust in traditional financial institutions, that really spurred a dedicated community, mostly privacy-focused technologists and developers. They were driven, to seek radical alternatives, wanting to build a financial system that would not rely on the very institutions that had just failed so spectacularly. It was a real crisis of confidence, wasn't it? And out of that, this new vision for finance began to emerge.
That's an absolutely crucial point. The crisis laid bare some deeply embedded shortcomings of traditional finance that DeFi explicitly aims to dismantle and address. Just think about the sheer bureaucracy and layers in conventional financial systems. Our research highlights how traditional finance is often burdened by layers of bureaucracy and back-office staff, creating friction and inefficiency, just mountains of paperwork and processes. DeFi, by contrast, is built on these self-executing smart contracts, right?
Yeah.
Designed to eliminate all that baggage. It's about automating trust, really, rather than relying on an army of intermediaries.
Automating trust is a powerful phrase.
It is. And then consider the role of middlemen and spreads. Centralized finance, by its very nature, thrives on intermediaries taking large spreads or commissions. Let's use a tangible example to illustrate this. It makes it clear. Imagine Alice needs to buy 100 million euros. And on the very same day, maybe even the same hour, Carol needs to sell 100 million euros.
Yeah.
Both go to their banks. Alice's bank quotes her a rate to buy euros, maybe slightly higher. Carol's bank quotes her a rate to sell euros, maybe slightly lower. The difference between those two rates, that seemingly small spread, is the bank's significant profit. And all they did was facilitate a match that might have happened anyway. DeFi, through direct peer-to-peer interaction, aims to remove that middle layer entirely, theoretically passing those savings directly to the users. It's an ambitious goal, obviously, but that's the core motivation.
And it really makes you wonder, doesn't it? If those layers and spreads are eliminated, who truly benefits? It feels like a fundamental shift in value capture.
Precisely. Another critical aspect DeFi tackles is the inherent opaqueness versus transparency in financial systems. The traditional system is notoriously opaque. Try figuring out exactly where your money goes or how decisions are made inside a big bank. Our trust often has to rely on regulators' oversight, whose track record, as some sources frankly put it, has been dubious in preventing crises. We've seen that happen. In stark contrast, transparency is a key characteristic of blockchain technology and DeFi, where everything is transparent. You can literally see every transaction recorded on the public immutable ledger. It's a complete inversion of the traditional model. You don't need to trust, you can verify.
Verify, not trust, okay?
And that transparency also relates to delays and inoperability. In centralized finance, moving your own money can be agonizingly slow. It might take days to send money from your broker to your bank or vice versa, often held up by legacy systems, settlement times, manual processes. It feels archaic sometimes. With DeFi, the promise is that no such delay exists because of its inherently interoperable and automated nature enabled by blockchain technology. Money moves almost instantly across networks without needing human intervention to clear the transaction.
That speed difference alone feels revolutionary.
It is. But perhaps one of the most compelling and frankly most idealistic motivations for DeFi is its ambition to address the deep-seated inequality of opportunity embedded in traditional finance. Let's break that down. For entrepreneurs, high costs can stifle innovation before it even begins. Imagine a brilliant entrepreneur, maybe someone you know, with a fantastic project that promises, say, a 25% return on investment, a clear win for the economy, right? Jobs, growth. But if the cost of credit card borrowing for their nascent startup is a staggering 24%, well, that project, which could fuel economic growth, might never be pursued. It just doesn't make financial sense. DeFi seeks to dramatically lower these barriers to entry for capital.
So potentially unlocking projects that wouldn't otherwise happen.
Exactly. And then for investors, access to lucrative opportunities has historically been restricted to the already wealthy. It's a closed club, often. Our sources cite examples of exclusive investment groups, like one called R360, turning away even billionaires because they weren't the right kind of billionaire or didn't fit the profile. It starkly demonstrates that you need to be rich already to access some of the best investment opportunities. The system reinforces existing wealth. DeFi, at least in its purest form, tries to democratize this access. If you have the crypto, you can participate, theoretically. And finally, the crypto ideology presents this powerful, almost humanitarian promise, improving financial inclusion for unbanked populations in regions like Latin America, Africa, and Asia. By offering cost-effective means to access financial services via just a simple smartphone, it aims to empower billions who are currently excluded from the global financial system. This vision of truly democratized, accessible finance is, in many ways, the beating heart of the movement. Whether it achieves it is another question, but that's the goal.
That's a truly powerful vision of the why behind DeFi, especially that promise of financial inclusion. It really resonates. But it's also important, as you said, to understand that Bitcoin and DeFi aren't just isolated flashes in the pan. They didn't appear out of nowhere. They're actually the latest, most radical stages in a long, continuous evolution of money and financial innovation that spans millennia. Let's take a very quick walk through a brief history of money to put this into perspective, maybe focusing on the problems each step tried to solve. We can go all the way back to 9000 BCE with barter in ancient Egypt, goods like cows exchanged for sheep, very practical and simple economies. But it had a fundamental problem. You needed to find someone who had exactly what you wanted and wanted exactly what you had. And that's the matching problem that money, in all its forms, ultimately solved. It's inefficient. Fast forward to 600 BCE, and we see coins emerging in Lydia, modern-day Turkey. This is a massive leap: portability, divisibility, standardization. You no longer needed to carry a cow around.
Much easier.
Definitely. Then, in 1290, banknotes were introduced to Europe by Marco Polo, though they actually originated much earlier in China. They offered a new form of easily transferable representational value, saving you from carrying bags of heavy coins. Again, convenience. Now here's where it gets truly interesting as we move towards modern digital finance. 1871 marks e-money with the first Western Union money transfer, electronic value transfer. Back then, it came with a 3% fee, and you know what's absolutely shocking? Our research points out, not much changed in 150 years. Even today, a $47 USD fee can be applied to a $300 USD transfer via Western Union in some cases. The percentage is remarkably similar. It makes you think.
It really does. The core model hasn't changed that much.
Exactly. After that, we saw the introduction of credit cards in 1950 with Diners Club, bringing convenience and, well, credit. Then the ATM arrived in 1967, courtesy of Barclays Bank in London, giving us 2047 access to our cash, a huge step. 1983 brought telephone banking with Bank of Scotland's HomeLink, shifting banking from physical branches to our homes. Then internet banking becoming widespread by 1994 with Stanford Federal Credit Union, truly digitizing the banking experience. And finally, we get closer to today. Contactless payment emerged in 1997 with mobile's SpeedPass RFID device, leading into 2005 with chip and PIN for credit cards, making transactions faster and supposedly more secure. Every single one of these steps was an attempt to make money easier to use, faster to transfer, and more accessible. DeFi is just the latest, arguably most radical step in this very long journey.
That's a brilliant timeline, truly illustrating how money and its mechanisms have continually adapted to solve problems and meet evolving needs. It's always about reducing friction. And speaking of how value is created and sustained, there's a fascinating historical anecdote that truly drives home the intangible nature of money's value. The Iraqi Swiss Dinar. This was the currency of Iraq until the first Gulf War in 1990. After the war, in 91, Iraq was politically split. Saddam Hussein controlled the south, the Kurds were in the north. Due to sanctions, new dinars couldn't be imported. These were high-quality notes printed in Switzerland. So Saddam ordered the printing of a new, lower-quality, rapidly inflating currency, the Saddam dinar. In May 1993, the Central Bank of Iraq announced a 3-week window to exchange old 25 dinar notes, the Swiss ones, for new ones. But here's the kicker. The old Swiss dinar, the exact same physical notes, continued to be used and retained its value in northern Iraq and the Kurdish region, even without official backing from any central bank or government. Saddam's new dinars inflated so rapidly that soon 300 of his new dinars equaled just one old Swiss dinar. The key insight here is profound. The Iraqi Swiss dinar had no official backing, no government decree supporting it anymore, yet it retained its value purely because people were willing to accept it as money. It was based on collective belief and trust in the quality and scarcity of the old notes.
Wow, so the value wasn't in the paper or even the government promise anymore, but purely in the shared belief.
Exactly. It connects beautifully to other historical examples like the island of Yap's famous stone money giant stone discs, way too heavy to move, that served as currency purely through collective agreement and public ledger keeping in people's minds. It really emphasizes the crucial difference between tangible value, which something is physically made of, and intangible value, which is based entirely on collective trust, consensus, history, and acceptance. Money is fundamentally a social construct.
And this brings us right to the digital age and the very origins of crypto, which, when you think about it, is perhaps the ultimate expression of intangible consensual value, especially Bitcoin. Bitcoin isn't just some random invention. It has a clear intellectual lineage. It built on previous ideas. Back in 1991, Stuart Haber and Scott Stornetta actually invented the foundational concept of the blockchain itself, but their goal was much simpler. Originally, just to keep track of timestamping documents digitally, ensuring their integrity, proving they hadn't been tampered with. Then, in 2002, Adam Back developed the idea of proof of work. Now, this was actually based on earlier work by Cynthia Dorp and Monino in 1992, and its initial purpose. Interestingly, it was aimed at eliminating junk mail. By requiring a small computational task from the sender, it would make sending mass spam emails uneconomical.
A clever idea in itself.
Very clever. And then, the true stroke of genius. The enigmatic Satoshi Nakamoto in 2008. Whoever they were, they put these ideas together to introduce Bitcoin with that groundbreaking white paper published on October 31st, 2008, Halloween. The actual program officially launched on January 3, 2009. What Nakamoto introduced was truly revolutionary, programmable money. Money that could be sent and controlled not by institutions, not by governments, but by pure code. Rules without rulers, as some say. The evolution, of course, didn't stop there. In 2014, Apple Pay entered the scene, making contactless payments even more mainstream, really paving the way for digital wallets on our phones. And remarkably, by 2022, blockchain initiatives were widespread across all leading banks. Think about that shift. We even saw the Office of the Comptroller of the Currency, the OCC in the U.S., granting explicit permission for federally chartered banks to participate in independent node verification networks and use stablecoins for payment activities. That's huge. Goldman Sachs CEO David Solomon summed it up perfectly when he stated, "Assume that all major financial institutions around the world are looking at the potential of tokenization, stablecoins, and frictionless payments." This just illustrates how ingrained these once fringe concepts are becoming in the financial mainstream, moving from the edges right into the core of financial thinking.
It's truly fascinating to compare Bitcoin to traditional fiat currencies like the US dollar. The US dollar, for instance, has been a purely fiat currency since 1971, right? Meaning it's not backed by a physical commodity like gold anymore. Its demand stems from 3 primary sources: the legal requirement to pay taxes in USD, the fact that many goods and services are priced in USD, and the need to repay debt denominated in USD. Economic expansions and contractions directly impact its value, and central banks like the Federal Reserve have the ability to inflate or deflate the money supply to manage the economy, which they do constantly. Bitcoin, however, presents a fundamentally different paradigm. Its inherent scarcity, with that hard-coded finite supply of 21 million coins ever. And it's designed for self-sovereignty, meaning you control your own funds directly with your private keys without needing intermediaries. These create the potential for store of value. Now, while it remains relatively untested in the very long term compared to gold or fiat, There's no direct link to the economic activity of one nation or the inflationary policies of a single central bank. This suggests it could potentially serve as a unique hedging mechanism against broader economic uncertainty or inflation. It's a different kind of asset entirely.
A completely different animal. Okay, so here's where it gets really interesting for me, and I suspect for our listeners too. All this history, all this motivation, it leads us to the crucial question: how does any of this actually work? What are the fundamental technical underpinnings that allow this new financial paradigm to exist, to function, and to promise such radical change? Let's get into the nuts and bolts.
Absolutely. To truly understand DeFi, we need to begin by dissecting its foundational technologies, starting from the broadest concept and then drilling down into specifics. At the very base, the bedrock is distributed ledger technology, or DLT. In simplest terms, imagine a single ledger, a record book, but instead of one copy sitting in one place, like a bank's central database, it's replicated and shared across numerous independent computers or nodes in a network. Hundreds, thousands, potentially millions. Every single transaction added to this shared ledger is recorded, tracked, and authenticated using a unique cryptographic signature. That's the core idea. Shared, validated truth.
Okay, shared ledger. But the cryptographic signature part sounds key. How does that work?
It is absolutely key. The cryptography is what provides security and trust. There are two main types involved. First, there's symmetric key cryptography, or SKC. This uses a single secret key for both encrypting and decrypting data. Think of it like a single password for a locked file. Simple, but you have to securely share that key. More relevantly for cryptocurrencies, we have asymmetric key cryptography, or AKC. This is where it gets really clever, and it's the foundation of crypto wallets. AKC employs separate keys, a public key and a private key. They're mathematically linked, but one can't easily be derived from the other. Here's how it works. The sender digitally signs a message or transaction with their private key. This is like their secret signature. The receiver, or anyone else on the network, can then verify that signature using the sender's public key, which can be shared freely. The critical part, the mathematical magic, is that your private key must remain absolutely confidential, like your secret PIN or the key to your house. If you lose it or someone steals it, they control your funds. But your public key can be freely shared without compromising security.
It's like your bank account number or email address people need it to send you stuff, but they can't access your account with it. It's incredibly difficult. Computationally infeasible with current computers, really, to figure out the private key just by knowing the public one. That's the security guarantee.
Okay, so public key is like the address, private key is like the actual key to the mailbox.
Yeah, that's a great analogy. And cryptocurrencies, like Bitcoin, for instance, rely heavily on elliptic curve cryptography, or ECC, which is a particularly efficient and powerful example of AKC. This is the advanced math that scrambles your transactions, making them super secure and ensuring several key properties. Pseudonymity, your real-world identity, isn't directly linked to your transactions. You're represented by your public address, though transactions can be tracked on the public ledger. It's not true anonymity usually. Integrity, meaning you can detect if any transaction data has been tampered with after it's signed.
Yeah.
And non-repudiation.
Wait, back up a sec. Non-repudiation, that sounds technical. For someone like me who might not be a cryptographer, what does that actually mean in practice? What does it prevent?
Great question. It sounds complex, but the concept is simple. In plain English, non-repudiation means you can't later deny that you sent a message or authorized a transaction. Think of it like a digital, unforgeable signature on a legally binding document. If you sign a transaction with your private key, the cryptographic proof is there. It's irrefutable that it originated from the wallet associated with that private key. You can't say, oh, that wasn't me, or someone faked my signature. It provides cryptographic proof of origin, which is absolutely fundamental to building trust in a decentralized system where you often don't know, or even need to know, the real-world identity of the person you're transacting with.
Okay, so it proves you did it digitally. That makes sense.
Exactly. Now, while this technology is incredibly robust today, there are emerging technological challenges on the horizon. The big one people talk about is the advent of quantum computing. Imagine computers so powerful they could theoretically break today's encryption standards by rapidly solving those underlying mathematical problems we rely on. While most experts agree that cryptocurrencies aren't in immediate danger, we're likely years, maybe decades away from quantum computers powerful enough to pose a real threat. The ecosystem will definitely require infrastructure upgrades to develop quantum-resistant cryptographic solutions to remain secure in the long term. This is a very active area of ongoing research and development. People are already working on post-quantum crypto.
So a future challenge, but one people are aware of.
Definitely aware. Okay, so
Building on DLT, we have blockchain technology itself. This is a specific type of DLT. As we mentioned, it was famously invented way back in 1991 by Haber and Stornetta, initially just for time-stamping document versions, not for currency. Its mechanics are quite elegant, really. Data transactions usually is recorded in blocks. Think of these like pages in the ledger. And these blocks are linked through a hashing process, forming a chain. Each new block contains a cryptographic fingerprint or hash of the previous block. This inherent linkage is what ensures immutability. Once a transaction is recorded in a block and added to the chain and subsequent blocks are added on top, it becomes incredibly difficult, virtually impossible computationally, to alter or remove it without disrupting the entire chain, which the network would reject.
So the chain structure itself provides the security against tampering.
Precisely. And each block isn't just added randomly. It's created via a consensus algorithm. This is crucial. A consensus algorithm is essentially a set of rules and processes that ensures all participants in the network, the nodes, agree on the validity of the transactions in a block and agree on which block gets added next to the chain. It ensures that only trusted nodes, according to the rules of the protocol, can add information, preventing fraudulent transactions or double spending. This consensus mechanism is what replaces the central authority, like a bank. Cryptocurrencies like Bitcoin and Ethereum operate on this decentralized and permissionless model, allowing for secure transactions without needing that central authority. Historically, though, this security and decentralization, especially with certain consensus methods, has often come at the cost of incurring high energy costs, which has been a major point of criticism.
Right. The energy consumption, especially for Bitcoin, is something you hear about a lot. It certainly sounds like a significant hurdle. How do they address that? Are there alternatives?
Yes, absolutely. That energy concern is very real, and it's driven a lot of innovation. This is where the different types of consensus algorithms come into play. The two most known and widely used are proof of work, or POW, and proof of stake, or POS. POW, famously used by Bitcoin, involves validators, we usually call them miners in POW systems, competing to solve complex cryptographic puzzles, basically guessing a huge number. The first one to solve the puzzle gets the right to add the next block to the chain and earns a reward, typically newly minted cryptocurrency and transaction fees. This process demands significant computational power and electricity because you need specialized hardware running constantly to guess those numbers. That's where the high energy consumption comes from. POS, on the other hand, takes a different approach. It selects participants, often called validators or stakers, to create new blocks, not based on computational power, but based on the number of coins they stake. Staking means they lock up a certain amount of the network's native cryptocurrency as collateral. Think of it like a security deposit. If they act maliciously, they risk losing their stake. POS was specifically developed to address both the environmental concerns of POW and also often its scalability limitations. It's generally much less energy intensive.
So staking replaces mining, essentially.
In a nutshell, yes. And a powerful and very real example of this shift is Ethereum's momentous move in 2022. They transitioned their entire network from proof of work to proof of stake in an event called the Merge. It was a massive technical undertaking, years in the making, and the results were dramatic. It reduced the Ethereum blockchain's energy usage by an estimated 99%, almost overnight. It was a huge step towards more sustainable blockchain operations and showed that major networks can evolve.
Wow, 99% reduction. That's incredible.
It really was a landmark event. Now, this discussion of trade-offs brings us to a fundamental challenge articulated by Vitalik Buterin, the co-founder of Ethereum. It's known as the blockchain trilemma. This concept highlights an inherent tension, a difficult balancing act. Blockchain technology struggles to simultaneously optimize three critical aspects: security, resistance to attacks; scalability, the ability to handle a large volume of transactions quickly and cheaply; and decentralization, avoiding single points of control or failure. The trilemma suggests that developers often have to make choices, prioritizing two of these aspects, usually at the expense of the third. Think of it like trying to build that perfect house again. You can make it incredibly secure, like a fortress, incredibly fast to build, scalable construction, or have it designed and built by everyone in the community, decentralized planning. But it's really hard to maximize all three simultaneously without making some trade-offs.
So you might get security and decentralization, but struggle with speed.
Exactly. For instance, Bitcoin is generally considered highly decentralized, and its pile mechanism provides high security due to the immense computing power required to attack it. But its design, with things like block size limits and the time it takes to mine a block, inherently makes scalability challenging.
It can only process a handful of transactions per second globally, which leads to high fees during peak demand. This trilemma, however, is not a dead end. It actually fosters immense competition and innovation in the crypto space. Everyone is trying to solve it or find better compromises. It's led directly to the development of Layer 2 scaling solutions. Think of these as technologies built on top of an existing Layer 1 blockchain, like Ethereum. Their entire purpose is to improve efficiency, boosting the number of transactions per second significantly and reducing those often high gas fees or transaction costs. Ideally, without compromising the decentralization and security of the main chain, Layer 1.
So layer 2 is like adding extra lanes to the highway?
That's a perfect analogy. It takes some of the traffic off the main Layer 1 chain, processes it faster and cheaper, and then bundles the results back to Layer 1 for final settlement and security. So you end up with this sort of hierarchical structure. Layer 0 is the underlying internet infrastructure and protocols. Layer 1 is the main blockchain itself, like Bitcoin or Ethereum, where core transactions happen and security is anchored. Layer 2 consists of these scaling solutions built on top, like the Lightning Network for Bitcoin or Polygon, Arbitrum, Optimism for Ethereum. And Layer 3 is often considered the application layer, where decentralized applications or dApps are built to provide the actual user interface and experience, making it easier for you to interact with the underlying system.
Okay, that layered structure makes sense. Layers upon layers for different functions.
Exactly. And finally, within these layers, we arrive at what truly powers the automation and the programmable aspect of DeFi. Smart contracts. These are truly revolutionary pieces of code. You can think of them as self-executing codes that initiate actions when predefined conditions are met. They facilitate functionalities like conditional payments. If X happens, then automatically release payment Y, without any human intervention or needing a traditional legal middleman like an escrow service. Now, the concept was actually proposed way back in the 1990s by the computer scientist and cryptographer Nick Szabo. He envisioned digital vending machines, essentially. But the idea was significantly advanced and popularized with the introduction of Ethereum by Vitalik Buterin and his team around 2014. Ethereum was built specifically to run smart contracts easily. Smart contracts have effectively revolutionized crypto applications by replacing traditional financial infrastructures like clearinghouses, escrow agents, even some legal agreements with automated code. They potentially offer greater value to a wider user base by reducing costs and increasing speed. They allow predefined conditions to control spending, manage assets and data, and define complex interactions without a trusted third party. The code is the trusted party. The costs for executing these contracts on the blockchain, often called gas fees, vary based on the code's complexity and the amount of data it needs to process or store. More complex actions cost more.
So the contract itself lives on the blockchain and runs automatically.
Precisely. Now, for smart contract to be really useful for real-world applications, they often need external data. A contract settling a bet on a sports game needs to know the final score, right? That's where oracles come in. Oracles are critical components, basically trusted data feeds that provide real-time external data like stock prices, weather information, election results, flight delays, you name it, to the smart contract on the blockchain. Without reliable oracles, the smart contract operates in a vacuum, unaware of the outside world conditions it might depend on. Oracle security is itself a huge area. Then there are bridges. Since there are many different blockchains, Bitcoin, Ethereum, Solana, etc., bridges enable interoperability between them. Think of them as digital tunnels or gateways that allow assets or data to move from one blockchain network to another. So you could potentially use Bitcoin within an Ethereum DeFi application. However, it's really worth noting, and we've seen this repeatedly, that these bridges can be targets for major attacks because they often hold large amounts of crypto assets locked up as they facilitate these cross-chain transfers. They represent significant security vulnerabilities in the current ecosystem. Many of the biggest hacks have involved bridges.
Okay, oracles bring data in, bridges let assets move between chains. Got it.
And the market for smart contracts themselves is projected to grow significantly. Our sources mention figures from US $1.9 billion in 2023 to a remarkable US $9.2 billion by 2032, with North America, the UK, and Germany often cited as leading adoption. And importantly, beyond just crypto finance, smart contracts are gaining significant interest in public and retail sectors. People are exploring them for things like secure transfer of property documents, digital deeds, identity management systems, and creating transparent, auditable supply chain records. It's a technology with potentially far-reaching implications well beyond just DeFi.
Fascinating stuff. So, okay, we've got the tech foundation, DLT, blockchain, consensus, smart contracts. What does all this mean for you, the listener, in terms of the actual things being created and traded? All these foundational technologies have paved the way for a frankly dizzying array of digital assets. Let's try to decode them and understand how they're actually brought into existence and traded, because understanding the assets is key to grasping this new financial frontier.
Absolutely. Crypto assets, often simply called tokens, are indeed a major application of blockchain technology. They encompass valuable digital or virtual items that are created, stored, and traded on these digital platforms, primarily decentralized exchanges, DEXs if we're talking pure DeFi, but also centralized exchanges, TEXs. Since Bitcoin's advent, literally thousands of diverse crypto assets have proliferated. It's a Cambrian explosion of digital value forms, each with its own purported purpose or function. Now, while there isn't one single universal definition of crypto assets that everyone agrees on globally, the EU's Markets in Crypto Assets Regulation, or MiCAR, offers a significant legislative effort to define them. MiCAR defines them broadly as a digital representation of a value or of a right that can be transferred and stored electronically using distributed ledger technology or similar technology. It's a functional definition. There seems to be a general consensus, though, on three key characteristics you typically see. One, they are often the creation by private individuals or groups using sophisticated technology, not usually issued by governments, with the exception of CBDCs, which we'll get to. Two, they require storage in electronic wallets, controlled by the user's private keys. And three, they are typically acquisition through platform exchanges, direct user transfers, or sometimes mining or staking rewards.
Okay, so privately created, stored in wallets, acquired through platforms or rewards. Seems clear enough.
Right. But European authorities have emphasized a crucial distinction since around 2018, which is really vital for understanding the regulation and, importantly, the risk profile. We need to differentiate. On one hand, you have cryptocurrencies in the stricter sense, like Bitcoin or Ether, before the merge perhaps. These are typically the native assets of their own blockchain, often mined within distributed public and permissionless networks. They primarily function as a medium of exchange and as store of value, are typically not considered securities under most existing laws, though this is debated, and while often volatile, are generally seen as less susceptible to fraud in established networks due to their transparency, long track record, and decentralized nature. On the other hand, there are other tokens, often issued via initial coin offerings or ICOs or similar mechanisms. These are non-native tokens tied to specific projects or platforms built on top of existing blockchains, usually Ethereum. They might grant access to services or products, utility tokens, or even financial rights like dividends or profit shares, security tokens. The regulatory implications are much more complex and uncertain. Depending on their specific design and function, they may be classified as securities, which subjects them to much stricter registration and disclosure requirements, or potentially as electronic money or payment instruments. Crucially, these types of tokens generally carry higher risks of frauds given the unproven nature of their underlying projects and the teams behind them. There's a lot more due diligence required. So buyer beware is the mantra here.
That distinction between native cryptocurrencies like Bitcoin and these other project-specific tokens is really important for anyone navigating this space. Huge difference in risk and regulation. Now, let's break down the main categories of crypto assets people encounter, because they each serve very different purposes and behave quite differently. First up, and maybe most relevant for stability, we have stablecoins. As the name implies, these are tokens specifically designed to maintain a fixed value, usually pegged one-to-one to something stable in the traditional world. They are typically tied to a fiat currency or commodity, like the US dollar or gold. Their main purpose is clear: to address cryptocurrency volatility, which is notoriously high. They aim to reduce the impact of market volatility and allow users to protect their capital during market downturns or lock in profits after a successful trade without needing to convert back to traditional currency and leave the crypto ecosystem entirely. They act as a sort of digital dollar within crypto.
A very important function within the ecosystem.
Definitely. Now, there are a few types, but the most common by far are fiat collateralized stablecoins. Examples like Tether, USDT, or USD coin, USDC, fall into this category. They claim to hold reserves actual US dollars or equivalent safe assets in traditional bank accounts, supposedly $1 in reserve for every one stablecoin token issued. However, our sources rightly emphasize that this model relies heavily on trust in the issuing entity. You have to trust that they actually hold those reserves and that those reserves are properly audited. This also introduces a level of centralization back into the system because you're relying on a specific company, not just decentralized code. There have been controversies around the reserves of some stablecoins. Then there are other mechanisms, often more complex and sometimes riskier. Briefly, you have crypto-collateralized stablecoins like DAI, which are backed by an over-collateralized pool of other cryptocurrencies, and algorithmic stablecoins, which try to maintain their peg using complex algorithms to automatically adjust supply and demand. These have proven particularly risky, as seen with the Terra SD collapse.
Yes, the algorithmic ones have a troubled history.
Indeed. Now, MiCAR, that EU regulation we mentioned, actually categorizes stablecoins quite carefully. It distinguishes between asset reference tokens, which reference a basket of values or rights, like multiple currencies or commodities, and are subject to very stringent authorization and EU-level supervision, and e-money tokens, which are linked to just a single official currency, like the euro or dollar, and are regulated similarly to traditional electronic money issuers. It's bringing them into the regulatory fold. Okay, moving beyond stablecoins, we have security tokens. These are pretty straightforward, conceptually at least. They are DLT-based assets that confer rights and obligations similar to traditional financial instruments like shares or debt. Think of them as digital representations of stocks or bonds. They literally transform buyers into investors by offering potential interest payments, dividends, or voting rights, just like traditional securities. And crucially, they are generally regulated securities in many jurisdictions, meaning they fall under existing financial laws and require compliance with things like investor protection rules and registration. Then there are utility tokens. These are quite different. They are crypto assets that provide access to a good or service offered by the issuer rather than functioning as securities. Think of them like a digital voucher, an arcade token, or a membership pass for a specific online platform or service. Holding the token grants you the right to use something within that ecosystem. Because they don't typically represent an investment contract, they are generally excluded from financial instrument regulations, lack stabilization mechanisms, their price can fluctuate wildly based on demand for the service, and simply grant holders the right to use a specific product or service. They're about access, not investment returns, though people certainly speculate on their value. Finally, perhaps the most talked about category in recent years, non-fungible tokens, or NFTs. These are truly unique beasts. They're defined as unique digital assets representing ownership of specific items such as art, collectibles, virtual land, or even event tickets. Unlike fungible assets like a Bitcoin or a dollar bill, where one unit is perfectly interchangeable with another, NFTs are not interchangeable. Each one is distinct, like an original painting versus a print. Their value is derived from individual characteristics like rarity, creator reputation, historical significance, or artistic merit. The NFT market exploded a few years ago, and while it's cooled off, it's still projected to generate significant revenue. One source mentioned US $2,378 million by 2024, largely driven by digital art and collectibles. Think of iconic examples like the Chromie Squiggle generative art project or the massive marketplaces like OpenSea, where these unique digital items are bought, sold, and traded. The EU regulator points out quite rightly that NFTs cannot be readily compared or valued against existing markets due to their distinct nature, which makes them a fascinating yet highly speculative and complex asset class. It's hard to pin down their true value.
Absolutely. The uniqueness makes valuation very subjective. Now, it's equally important to clarify what, in this specific context of privately issued crypto assets, is explicitly not considered a crypto asset. The primary example here, and one causing some confusion, is central bank digital currencies, or CBDCs. These are fundamentally distinct because they are issued directly by central banks and represent their direct liabilities, just like physical cash issued by a central bank. They are government money in digital form. Consequently, they do not respect two of the three conditions typically used to define cryptocurrencies. Namely, they are not privately issued, and they are not typically acquired through platform exchanges, user transfers, or mining rewards in the same way. They're distributed through the existing banking system or directly by the central bank. They are, in essence, digital versions of a nation's fiat currency: the digital dollar, the digital euro, the digital yuan.
So government-issued digital cash, not private crypto.
Exactly. And we can further distinguish between two main types of CBDCs being explored: general purpose or retail CBDCs, which would be accessible to everyone, the general public, and businesses just like digital cash for everyday payments; and wholesale CBDCs, which would be restricted to financial institutions, primarily for interbank payments and settlements, functioning more like digital central bank reserves. These could potentially improve the efficiency of large value payments, including cross-border ones. Now, it's important to note there's considerable heterogeneity in how different countries are designing their CBDCs. You have very different models being tested or implemented, like the Chinese digital yuan, EUCNY, the Bahamian sand dollar, the Nigerian Naira,
and pilot projects like the Swedish krona. Each design requires careful consideration regarding crucial factors like user privacy, how much data does the government collect, the precise role of commercial banks in distributing and managing CBDCs, and their legal definitions as actual currency. It's a complex policy area.
Okay, so CBDCs are a whole different category. Government-led. Got it. Now that we understand the various types of digital assets, stablecoins, security tokens, utility tokens, NFTs, and not CBDCs, let's talk about the dynamic processes of actually bringing these assets into existence and trading them. This is where the action really happens, right? The creation and exchange. A significant method for issuing new crypto assets, especially during that boom period, has been initial coin offerings, or ICOs. These are best described as a crowdsourced fundraising method for launching new tokens, coins, and services. Basically, startups raising capital directly from the public using crypto. Companies raise money, often in established cryptocurrencies like Bitcoin or Ether, in exchange for their newly created tokens. The typical process involves a pre-sale phase for early investors, defined funding caps, either a hard cap, the maximum amount they aim to raise, or a soft cap, the minimum amount needed for the project to proceed, and usually a detailed white paper outlining the project's vision, technology, team, and tokenomics, how the token works, and its value proposition.
The white paper is key, though the quality varies wildly.
Absolutely. And it's important to distinguish again between ICOs for utility tokens, access tokens, and those for security tokens, investment tokens. When the token represents an investment contract, the offering is often referred to as a security token offering, or STO, because they are akin to traditional initial public offerings, IPOs, in function, meaning they represent an ownership stake or a right to future profits and are thus subject to securities regulations. The very first ICO was famously launched by Mastercoin back in 2013, but this method gained significant global activity, really peaking between 2017 and 2019, raising over US $31 billion globally. It was an absolute frenzy, the ICO boom.
A real Wild West.
Totally. However, research notes a sharp decline in ICO activity by 2021. Why? Primarily attributed to widespread fraud, a lack of regulatory oversight, and consequently reduced investor trust, after many high-profile projects failed to deliver, disappeared with the money, or proved to be outright scams. It's a classic boom and bust cycle, really demonstrating the inherent risks of an unregulated, hype-driven market. Regulators started cracking down too.
Understandably so. Now, when it comes to actually trading these assets once they're issued, we see two main types of environments emerging: centralized and decentralized exchanges. Crypto asset exchanges broadly, whether they are centralized CEXs or decentralized DEXs, have emerged as dominant financial institutions in the crypto economy. They are the main hubs for activity, and they often offer various services beyond just trading, including things like issuing their own stablecoins, providing custodial services, holding crypto for users, facilitating payments, offering crypto lending and borrowing services, and even staking services, where users can earn rewards by locking up their crypto to help secure proof-of-stake networks. They're become crypto financial supermarkets in a way.
So much more than just places to buy and sell.
Exactly. However, the distinction between CEXs and DEXs is absolutely fundamental to the DeFi ethos. Centralized exchanges, CEXs, like the big names Coinbase or Binance, operate much like traditional stock exchanges or online brokerages. You create an account, deposit your funds, crypto or fiat, they hold those funds in custody for you, and you trade using their internal order books. They act as intermediaries, matching buyers and sellers. This offers convenience, often deeper liquidity, and familiar user interfaces, but it comes with drawbacks. You have to trust the exchange with your funds, counterparty risks like the FTX collapse showed. They control the listing process, and they operate less transparently. Decentralized exchanges, or DEXs, on the other hand, embody the core principles of DeFi. Unlike their centralized equivalents, DEXs use blockchain technology and smart contracts to enable fully transparent trading directly between users' wallets. This means you always maintain custody of your assets in your own crypto wallet. You connect your wallet to the DEX protocol, and trades happen directly peer-to-peer, mediated by smart contracts, often using automated market maker, AMM models, instead of traditional order books. You don't need to deposit funds onto the exchange or trust a third party to hold them. Platforms like Uniswap and Curve Finance are prominent examples of DEXs, enabling large-scale cryptocurrency trading outside of centralized exchanges and truly representing the non-custodial, transparent spirit of DeFi.
Maintain custody yourself. That feels like a core principle here.
It absolutely is. Self-custody is central to DeFi. Now, beyond just trading, specialized DeFi applications are rapidly reshaping specific financial services in innovative ways. Take decentralized lending, for instance. Platforms such as Compound, Aave, MakerDAO, which issues the DI stablecoin, and BZX have further propelled the popularity of decentralized lending. They've built multi-billion-dollar protocols around this. How do they work? They directly connect lenders and borrowers through smart contracts, completely bypassing traditional banks and credit checks. This allows lenders, or liquidity providers, to deposit their crypto assets into lending pools and earn attractive interest rates on their crypto assets by providing liquidity that others can borrow. The rates are often variable, determined by supply and demand within the pool. Borrowers, in turn, can gain access to instant liquidity by putting up other crypto assets as collateral, usually over-collateralized, meaning they have to deposit more value than they borrow. All of this happens algorithmically, without the burden of paperwork and often in a secure and anonymous environment, mediated entirely by smart contracts. It's a radical shift from traditional credit markets.
That sounds incredibly efficient, just code matching lenders and borrowers. But what about the risk? And I've heard about something called flash loans that sound almost too good to be true. How do those work without collateral? That seems counterintuitive.
You're right to be curious and cautious about flash loans. They are a particularly innovative, almost mind-bending concept unique to decentralized lending on blockchains that support complex smart contracts like Ethereum. They truly require no collateral upfront, and users can borrow substantial amounts, sometimes millions or even hundreds of millions of dollars worth of crypto, in a single transaction. The catch. The huge catch is that they must be repaid before the transaction block is completed. Blockchains process transactions in blocks, roughly every few seconds or minutes depending on the chain. A flash loan transaction bundles the borrowing, the actions taken with the borrowed funds, and the repayment all into one single atomic transaction. If any part of that sequence fails, if the borrower can't repay the loan plus a small fee by the end of that single transaction, the entire transaction simply fails and reverts. It's as if it never happened. The loan is never actually issued.
So it's like a financial time loop that only succeeds if everything works out perfectly within seconds.
That's a fantastic way to put it. An atomic financial time loop. This all-or-nothing atomic nature is what makes them technically collateral-free, because the funds never truly leave the protocol's control unless repayment is guaranteed within the same transaction. This makes them uniquely suitable for very specific, rapid profit operations such as arbitrage trading and debt refinancing. For arbitrage, you might use a flash loan to borrow millions, buy a token cheaply on DEX A, instantly sell it for a slightly higher price on DEX E, repay the loan plus fee, and pocket the difference all within one transaction. For refinancing, you can use a flash loan to pay off an existing loan on one platform and immediately take out a new loan with better terms on another platform, again atomically. However, and this is a big however, it's crucial to note that, if not managed carefully, they introduce potential vulnerabilities that may be exploited for fraudulent activities. Malicious actors have used complex flash loan attacks to manipulate prices on DEXs, drain liquidity pools, or exploit vulnerabilities in other DeFi protocols, causing significant losses. They are an incredibly powerful tool, but one that demands extreme technical precision and carries inherent systemic risks.
Wow. Powerful, complex, and risky. Sounds like DeFi in a nutshell sometimes.
It often is. We also see the emergence of DeFi payment gateways. These are systems aiming to bring crypto payments more into the mainstream for businesses. They use blockchain technologies to allow businesses to accept cryptocurrency payments directly, often bypassing traditional payment processors like Visa or MasterCard and their associated costs. Smart contracts automate these processes, potentially leading to faster transaction speeds, reduced fees, especially for cross-border payments, and increased transparency as the payments are recorded on the blockchain. They also have the crucial potential ability to integrate with different blockchain networks via bridges or interoperability protocols, which promotes flexibility and expands reach for things like cross-border payments, microtransactions where traditional fees are prohibitive, and even programmable payments where money can be automatically released only when specific conditions, verified by an oracle perhaps, are met. Imagine paying a supplier only when a shipment is confirmed as delivered. However, it's fair to say they still face significant obstacles that hinder widespread adoption. These include the lack of clear regulations around accepting crypto payments in many jurisdictions, the inherent volatility of many cryptocurrencies, which businesses may not want to hold, and sometimes complex user interfaces, which can be daunting for both businesses and customers new to crypto. The promise is definitely there, but the journey to mainstream adoption for everyday payments is still very much ongoing.
It's clear that the technological backbone of DeFi is complex and utterly fascinating, with things like flash loans pushing the boundaries. But no system operates in a vacuum, right? It's also crucial to understand the diverse set of human and organizational actors that actually drive, maintain, and sometimes govern this incredibly dynamic DeFi ecosystem. Who are the people involved? Let's start with the miners in proof of work systems or validators in proof of stake. These are absolutely integral players. Their core role in POW, for example, is to verify and package new transactions into blocks, essentially validating the ledger additions. For their intensive computational work, or their stake put at risk in POS, they are compensated through transaction fees paid by users and newly minted cryptocurrency, often called block rewards. This incentive mechanism is what secures the network. What's interesting is how Bitcoin mining, the classic example, has evolved over time. Our sources note that despite a rising overall hash rate, which is the total combined computational power securing the network, indicating greater security in theory, the number of individual miners has significantly decreased. It went from a peak of 67,911 estimated individual miners in 2010 down to just 144 identifiable large mining entities or pools in 2019.
A huge consolidation.
A massive consolidation. This indicates that operations have become more efficient and concentrated among fewer, larger participants, often organized into professional mining farms or collective mining pools where small miners contribute their hash power. By 2019, research notes a staggering 80% of the mining reward was earned by just 20% of miners or mining pools. So much for pure decentralization in practice there. Major geopolitical events also impact them dramatically. For example, China's sweeping crypto ban in 2021 forced a massive relocation of mining hardware, causing a significant shift in mining activity away from China, which was previously the world's largest miner by far, to places like the US, Kazakhstan, and elsewhere. It showed how real-world politics affects the supposedly borderless network. And then there are the built-in Bitcoin halvings, a pre-programmed event that reduces the rate of new Bitcoin creation by half approximately every 4 years, every 210,000 blocks. This directly influences Bitcoin supply and demand dynamics by making new supply scarcer and clearly affects miners' profitability as their block reward gets cut in half. The most recent fourth halving occurred on April 19, 2024, cutting the reward from 6.25 BTC down to 3.125 BTC per block. It's a continuous balancing act for these essential network participants driven by code.
A fascinating built-in economic policy, really.
Exactly. Now, next, let's talk about the core developers, or coders. These individuals play an absolutely crucial role in crypto asset governance, even if it's informal. They're the ones who write, maintain, and update the underlying software protocols that run these networks. They directly intervene in network protocols for updates, improvements, and vital bug fixes. Their influence is immense. Our sources categorize them broadly into a few types. You have the catalysts, who are often the original project founders or visionaries, like Satoshi or Vitalik Buterin. You have open source developers, who are often unpaid volunteers contributing their time and expertise to the public code base because they believe in the project or enjoy the technical challenge. And you have freelance coders or developers employed by companies or foundations like the Ethereum Foundation or Blockstream for Bitcoin, who are paid to work on specific aspects of the protocol or related infrastructure. The history of Bitcoin's core development is a prime example of this evolving, somewhat decentralized governance model. Satoshi Nakamoto initially created and managed the code, later involving other trusted experts. After Nakamoto's mysterious departure around 2011, Gavin Andresen initially took over as lead maintainer. But Andreessen himself later declined to manage the system alone, understanding the risks of centralization, leading eventually to the involvement of 4 other developers as Bitcoin Core developers, who collectively maintain the primary Bitcoin software implementation on GitHub based on community consensus for changes. This really highlights a key contrast with traditional centralized models. The Bitcoin network infrastructure, while having influential figures, is technically governed by a reduced number of mining pools and developers across different jurisdictions sharing the responsibility. Unlike a single, identifiable corporate entity making all the decisions, it's a form of distributed, often messy governance.
Messy is often the right word for crypto governance. And beyond these individual roles, we see innovative, though as you said, sometimes problematic, organizational structures emerging specifically within DeFi. The most prominent example, and one that really captures the DeFi spirit, is the Decentralized Autonomous Organization, or DAO. DAOs are defined as blockchain-based entities operating without centralized control, ideally. They are managed and governed collectively by their members through smart contracts that automate rules and execute decisions based on votes. Their defining characteristics are right there in the name: decentralization, aiming for no single point of control or failure; automation, using smart contracts to enforce rules and execute decisions automatically. Autonomy, having the ability to operate independently, modify their own rules via voting, and manage their own treasuries based on the collective will of token holders. Typically, governance tokens are issued by the DAO, and holding these tokens grants voting power to holders, theoretically distributing control among the community members.
However, research notes that in practice, significant decision-making influence often concentrated among institutional investors, venture capital firms, or the initial development team, who often receive or purchase a large share of these governance tokens early on. So decentralization can be relative.
So maybe not always as decentralized as the name suggests.
Often not perfectly, no. It's a spectrum, but the scale can be impressive. To give you an idea, Uniswap, which is one of the largest and most successful DEXs operating as a DAO, had a treasury capitalization managed by its token holders reportedly around $3.4 billion in 2023. These aren't small operations. Now, DAOs represent a genuinely new organizational form with some exciting potential benefits. In theory, they can reduce transaction and agency costs compared to traditional companies by automating processes and aligning incentives between the protocol and its users' governors. They can also increasing transparency and innovation because the governance process, the proposals, the voting, and the treasury movements are all typically recorded publicly on the blockchain. Anyone can scrutinize them. However, they also face significant, well-documented challenges. Security risks are a major concern, as the governing smart contracts themselves can have vulnerabilities. This was dramatically demonstrated by the DAO hack in 2016, an early, ambitious DAO project on Ethereum. A vulnerability in its smart contract code was exploited, leading to the theft of millions of dollars worth of Ether and causing a major crisis that eventually led to a controversial hard fork of the Ethereum blockchain itself. It was a foundational cautionary tale.
A very harsh lesson early on.
Indeed. Furthermore, DAOs often grapple with the persistence of traditional corporate governance issues, things like voter apathy, low participation in voting, the potential for plutocracy, rule by the wealthy token holders, and difficulty reaching consensus on contentious issues. And they introduce new complexities arising from the intricate involvement of miners, developers, and founders, DAOs. Who really holds power? Is it token holders, the core dev team, the original founders? The lines can be blurry. A practical challenge often cited is coordination inefficiencies. Because many decisions, even minor ones, might require a formal proposal and voting process involving potentially thousands of token holders across the globe, this can lead to significantly increased voting time and complexity compared to a traditional hierarchical company. It can also suffer from inactive participants, making it hard to achieve quorum or make agile decisions in a fast-moving market. It's a bold experiment in decentralized organization, truly, but still very much in its infancy and facing growing pains.
Okay, so we've journeyed through the genesis, the tech, the assets, the people, and these new organizational forms like DAOs. Now it's time for the big picture, pulling it all together. The evolving landscape, where's DeFi stand now? What are its real promises versus the perils, and what might the path forward look like? DeFi certainly presents this ambitious promise to revolutionize finance, a true paradigm shift, as some call it, moving away from centralized, intermediary-based finance towards a decentralized, peer-to-peer model. It's consistently touted as having the potential to eliminate many traditional intermediaries, leading, at least in theory, to greater transparency, accessibility, and control over financial services for the end user. On paper, it sounds like a financial utopia, almost. And the proposed advantages of DeFi over traditional banking, when you list them out, are indeed compelling. Let's recap them quickly. First, there's permissionless access. Ideally, no account applications or credit checks are required. Anyone with an internet connection and a crypto wallet can potentially participate regardless of their location or financial history. That's huge. Second, transparency and auditability. All transactions are recorded on public blockchains, providing a level of radical transparency and auditability by anyone that simply doesn't exist in the opaque ledgers of traditional banking. Third is composability and interoperability. DeFi protocols are often designed like Lego blocks, able to interact seamlessly with each other. This composability enables the creation of truly innovative financial products by stacking different DeFi services together in novel ways. Fourth, programmability and automation. Those smart contracts we discussed automate agreements and financial logic, reducing the need for manual intervention, human error, and costly overhead. And finally, for many users, perhaps the greatest allure is potentially higher returns. DeFi lending protocols and liquidity pools often offer higher interest rates or yields compared to traditional savings accounts or investment products. This is primarily because they aim to cut out those middlemen and pass more of the value directly to the users, providing capital or liquidity.
Those are definitely the key selling points, the vision pitched by DeFi proponents. And they are powerful ideas. However, while those promises are certainly appealing and the vision is grand, it's absolutely crucial to take a nuanced, critical look at where DeFi's ambitions meet the messy reality of the real world. There are inherent risks and significant unfulfilled promises that we need to address honestly. Let's start with that core promise of financial inclusion. Despite the strong crypto ideology promoting access for the unbanked, our research suggests the anticipated benefits of financial inclusion remain largely unrealized on a mass scale so far. There are significant obstacles. First, the persistent digital divide in emerging economies, lack of reliable, affordable internet access, low smartphone penetration in some areas, and limited digital literacy hinders the basic ability to interact with DeFi protocols. Furthermore, many existing DeFi on-ramps and major exchanges, the gateways for converting traditional money into crypto, still require users to have traditional bank accounts for verification or funding. This immediately excluding unbanked and low-income individuals from the very start. It's a practical barrier.
So the entry point itself can still be a hurdle.
Exactly. And counterintuitively, transaction fees on popular blockchains like Ethereum can become prohibitively high during periods of high network congestion. These gas fees can sometimes surpass those of traditional money transfer services, especially for the small transaction sizes typical of remittances or low-income users. Remember our earlier Western Union example. A $47 fee on a $300 transfer is certainly high, but during peak Ethereum congestion, a simple DeFi transaction could sometimes cost $50 and $100 or even more in gas fees, making it completely uneconomical for many potential users in developing countries. And then there's the critical lack of literacy, both technological and financial. Effectively using and investing in DeFi demands a high level of technological and financial literacy. Users need to understand wallets, private keys, smart contracts, impermanent loss, liquidation risks, scams. It's a steep learning curve. Many retail investors lack this understanding, which unfortunately leads to substantial financial losses through mistakes, hacks, or falling prey to sophisticated scams. We saw the devastating real-world impact of this with the failures of prominent crypto entities like Terra USD, the algorithmic stablecoin, and FTX, the centralized exchange, in 2022. In both cases, smaller investors faced significant challenges and losses, often losing their life savings due to risks they didn't fully comprehend or because of outright fraud hidden behind complexity.
Those were definitely wake-up calls for the industry and regulators.
Huge wake-up calls. This brings us to another critical question. Is DeFi truly an engine of efficiency or inefficiency overall? While DeFi certainly leverages technology to reduce transaction costs and time within its own ecosystem compared to some traditional processes, its effectiveness in enhancing broader market search efficiency and mitigating resource misallocations remains underexplored and potentially questionable. Ironically, the high granularity and completeness of DeFi markets, the sheer number of tokens, protocols, and yield opportunities available 24/7 while offering broad access, can actually increase the effort required to screen deeper markets. It can be overwhelming for individual investors to conduct proper due diligence on thousands of potential investments or complex strategies. Information overload is real. This suggests that these inherent inefficiencies in information processing and risk assessment might undermine the viability of fully decentralized fundraising and investment, possibly suggesting that entrepreneurial finance may gravitate back toward intermediated models, even within crypto.
So complexity itself might bring back the need for experts or guides.
Precisely. And we are already seeing clear evidence of this trend with the rising presence of institutional investors, such as specialized crypto venture funds, hedge funds, and asset managers entering the DeFi space. One report estimated that over 868 crypto funds worldwide managed assets amounting to approximately US $70.11 billion by late 2023. This indicates a growing degree of intermediation within DeFi, driven by the high participation costs, both capital and knowledge, the need for extensive technical and financial due diligence that individuals often can't perform, and the desire of large investors for trusted counterparties. The smart money often relies on specialized funds.
That's a crucial point. So, despite the promise of cutting out the middleman entirely, it seems the complexities and risks of this new frontier are actually creating a demand for a new form of specialization, perhaps even a new kind of tech-savvy middleman or advisor.
Exactly. It's a fascinating evolution, isn't it? The market adapts and finds ways to fill the gaps created by complexity and risk. The intermediaries might look different. Maybe they're auditors, specialized funds, or sophisticated analytics platforms, but the function persists. Now let's pivot and confront the perils of decentralized finance head-on, because the risks are substantial and cannot be overstated, especially for newcomers. First and foremost, cybersecurity risks are absolutely paramount and persistent. DeFi's heavy reliance on complex, often unaudited smart contracts means any vulnerabilities in its code can be exploited by hackers, potentially leading to significant financial losses for users of that protocol. We've seen countless dark examples of this. One source mentions hundreds of millions of dollars of Ether, stolen in 2024 after hackers found a bug in some code used by multiple DeFi projects. These aren't isolated incidents. Major hacks happen with alarming regularity. Research is quite clear. DeFi is far more prone and susceptible to hacking than traditional finance in many ways. This is due to its distributed nature, larger attack surface, the often unknown or pseudonymous identities of stakeholders involved, less accountability, the open source nature of the code, which, while transparent, can also expose vulnerabilities to attackers, and the immutability of the blockchain, making it hard to reverse fraudulent transactions. It's a constant arms race between developers and hackers.
A very expensive arms race for the users who get hacked.
Tragically, yes. Then there are profound governance and accountability challenges. The very absence of a central authority or traditional legal entity, while a core tenet of decentralization, makes establishing clear lines of responsibility and resolving disputes incredibly complex. This raises critical, often unanswered questions. What happens if a DeFi protocol malfunctions or system crashes due to an erroneous data input from an oracle? Or what if a software compiler, the program in charge of building and executing the smart contract code, contains a subtle bug that leads to losses? Who is ultimately responsible for fixing these issues, compensating users, or making critical modifications in a truly decentralized system where there's no CEO to call, no customer support department, no board of directors to hold accountable? Governance in DAOs, as we discussed, is still experimental and often struggles with these practicalities.
So when things go wrong, who do you even turn to?
That's often the multi-million-dollar question with no easy answer. This leads directly to the overarching lack of a clear legal and regulatory framework surrounding much of DeFi globally. There's often an absence of clear legal identity for the parties involved in peer-to-peer DeFi transactions. Are DAOs legal persons? Can smart contracts form binding legal agreements? Financial contracts, often existing only as complex code, can lack transparency for non-coders, trust beyond the code itself, and a reliable legal enforcement architecture. They frequently miss basic legal requirements found in traditional contracts, like clear terms, identification of parties, or even consideration in a legal sense. There's often no clear governance architecture for communications instructions to terminate a contract if things go sour, or established impartial dispute resolution strategies beyond forking the code or community votes, which can be contentious. The critical question looms large for a truly global, borderless system like DeFi. What will be governing state law that applies? Or is some kind of mutually agreed multilateral virtual organization needed for international coordination, setting standards and regulation? We're nowhere near that yet. Research even highlights that despite the claims of pure decentralization, in reality, some programmers and app owners certainly have disproportionate sway over the DeFi system through things like admin keys, control over protocol upgrades, or influence over Oracle feeds. This raises legitimate concerns, as one source puts it bluntly, that the crooks will get control over most of the computers that run a blockchain, or the protocols on top if governance isn't robust and transparent. Centralization risk creeps back in.
So the legal and regulatory uncertainty is a massive shadow over the space.
A huge one. Furthermore, a practical limitation often overlooked is collateralization. Unlike traditional finance, where loans are often granted against less liquid assets like a home, a vehicle, or future income streams, DeFi lending almost always requires significant over-collateralization with highly liquid crypto assets, often 125% to 150% or more. This means you need to already have substantial crypto wealth to borrow against it. This practice vastly restricts the access of DeFi loans for those who need them, most individuals or businesses without existing crypto assets to pledge as collateral. It limits that financial inclusion promise significantly. The largely ungoverned and pseudonymous nature of DeFi also makes it undeniably attractive for the facilitation of illicit activities. While the scale is debated, it's clear they can be used for drug peddling, illegal trade, illicit financing, ransom payments, ransomware, black money investments, and siphoning off funds via hacks and scams. This is largely due to the inherent difficulty of viable tracking of financial and trade transactions across pseudonymous blockchain addresses and the existence of privacy-enhancing tools like mixers. Law enforcement is catching up, but it remains a challenge. Finally, DeFi protocols, especially those involving stablecoins or lending pools, are potentially highly vulnerable to panics or bank runs. Unlike traditional bank deposits insured by governments or fiat currencies ultimately backed by nation-states and central banks, with tools like the Bank for International Settlement, BIS, coordinating responses, most digital currency is not backed by nation-states or multi-level international governance organizations in the same way. This lack of a lender of last resort or deposit insurance makes DeFi highly vulnerable to panics, where a loss of confidence can trigger rapid withdrawals, causing liquidity pools to drain, stablecoins to depeg, and protocols to collapse in a cascading failure. We saw glimpses of this during the Terra Luna crisis.
That systemic risk sounds pretty terrifying.
It is a significant concern. And just to illustrate the sheer complexity and inconsistency of current regulatory approaches, how different jurisdictions are grappling with this. Let's look briefly at a specific legal perspective from Japanese law, as cited in one of our sources. It paints a picture of the patchwork quilt of regulation. The source notes that under Japanese law at the time of writing, the basic lending and borrowing of crypto assets are not regulated under the Banking Act, meaning non-bank entities could potentially facilitate crypto loans without needing a banking license, unlike traditional lending. Interestingly, popular stablecoins like Tether, USDT, and USD Coin, USDC, are likely to fall under the definition of currency-denominated assets under Japanese law, and are thus technically excluded from the definition of crypto assets under their main Payment Services Act, PSA. They're treated more like foreign currency holdings. More nuanced are things like SON tokens, which are the interest-bearing tokens you receive when you deposit crypto into a lending platform like Compound, representing your share of the lending pool. These are deemed unlikely to be classified as traditional financial instruments, like regulated money market funds or collective investment schemes, mainly due to their unique yield mechanics and the lack of a traditional legal entity issuer. Instead, they likely fall under a lighter regulatory category of Type 2 crypto assets under the PSA. The issuance of governance tokens, like Compound's CoMP token, used for voting, is generally not considered an exchange business requiring registration, but treated more akin to a free airdrop for community participation. Even the seemingly simple question of who has custody of tokens locked in a smart contract is debated, particularly when the smart contract creator technically has no direct control over releasing those funds without user interaction or specific conditions being met. Is the protocol developer a custodian? It's legally ambiguous. This single example from Japan clearly highlights that much depends on the specific structure of the overall arrangement and the particular design of the token in defining how existing regulations might apply, or where new regulations are needed. It's not a globally standardized approach by any means. It's fragmented and evolving.
Wow. That Japanese example really drives home how complex and uncertain the legal landscape is. It's like trying to fit a square peg into a round hole with existing laws sometimes. So, what does all this mean for you, our listener, as you try to make sense of this rapidly evolving financial landscape? It feels like a real dichotomy, doesn't it? On one hand, DeFi represents this powerful, almost utopian vision of financial liberation, a potential technology of inclusion, as economist Campbell R. Harvey highlighted in his work, aiming to democratize access to financial services for literally everyone on the planet. The promise is huge, but on the other hand, it's also fundamentally an incipient industry. It's new, it's experimental, it's volatile, and it comes with significant inherent complexities and very real perils, as we've just discussed. It's a field of immense promise, yet equally immense, often unseen risk. It's definitely not a silver bullet solution for finance, but rather a powerful, experimental new set of tools with sharp edges.
That's a very balanced way to put it. And if we connect this back to the bigger picture, it becomes abundantly clear that truly understanding DeFi, its potential and its risks, requires integrating insights from multiple perspectives, simultaneously technological, financial, economic, legal, and regulatory. You can't just look at the code or just the market price. While the underlying blockchain technology itself is often claimed as impossible to alter and its transactions irreversible, the real-world series of electronic heists in digital currencies, the smart contract exploits, the protocol failures, well, they speak otherwise. The implementation, the layers on top, the human element, these are where the vulnerabilities lie. The core challenge, perhaps the central tension of DeFi today, remains how this nascent, borderless virtual economy, operating largely outside traditional legal structures and without any agreed global governance framework, interacts with the real world, the world of existing laws, regulations, national interest, and established norms and technical code of conduct. It's a clash of two very different systems, still trying to figure out how to coexist or merge.
A clash of systems. That really captures it.
And this raises a final important question for all of us to consider, something to mull over perhaps. Can the original promise of DeFi, a truly decentralized, permissionless, transparent, and inclusive financial system, ever fully mature and reach mainstream adoption without evolving a more robust, globally agreed-upon framework for things like governance, legal identity verification where appropriate, consumer protection, and effective dispute resolution? Or will the inherent perils, the hacks, the scams, the systemic risks, ultimately demand some form of re-intermediation, perhaps leading to a hybrid future model that tries to marry the benefits of decentralization and transparency with necessary layers of oversight, regulation, and accountability to protect users and ensure stability? It echoes that sentiment often attributed to Albert Einstein. In the middle of every difficulty lies an opportunity. The difficulties for DeFi are clear, but the opportunity to reshape finance for the better might still be there, suggesting the journey for DeFi is far from over and its ultimate form is yet to be fully realized. It's an ongoing, fascinating, high-stakes experiment, and its final chapter is still being written day by day, block by block.
A truly profound thought to leave us with. Is the future fully decentralized or some kind of hybrid? That's the multi-trillion-dollar question, isn't it? Well, thank you so much for joining us on this very deep dive into the fascinating, complex, and at times, frankly, tumultuous world of decentralized finance. We really hope this exploration has provided you with the comprehensive insights and the context you need to feel truly well informed on this vital and rapidly evolving subject. There's certainly a lot to keep track of. Until next time on the deep dive, keep exploring, keep asking questions, and keep learning.